In this video, we will see 3 undervalued stocks as of December 2024. I think there are great opportunities, and let's not waste more time. In case you are new to this YouTube channel, welcome. My name is Christophe Nour. I've been investing in the stock market for almost a decade with a performance of 25% per year, and I love these businesses. Let's start with the first one. The first one is Alimentation Couche-Tard. They reported earnings a few days ago, and they had a double miss. Basically, some recent weakness on earnings, some recent weakness on revenue. And if you look at the stock chart, basically the stock has always followed earnings. So now we are at the moment where the stock has not moved for many months. For maybe 1 year, you have a mismatch. You have a mismatch compared to the S&P 500, the Nasdaq, etc. So how I see the situation is a recent weakness. It's a compounder. They have grown earnings 18%, earnings per share, 18% for the past 20 years. So we are talking about a compounder. If you look at the long-term business, revenue is growing, net income is growing. For the past 10 years, it's beautiful, up and to the right. And you see there is a recent weakness. This is a company that is in the convenience stores in North America. This is a company from Canada, and they come into Europe, and they wanted to come in Japan a few months ago. This summer 2024, they offered to buy the equivalent of 7-Eleven in China. It's a big company for the Japanese culture. This was a bit shameful, I suppose, because the acquisition did not turn out very good. So in summer, Alimentation Couche-Tard and their management wanted to buy a big Japanese company. The acquisition was $40 billion. Compare it with the market cap of Alimentation Couche-Tard of $50 billion. So we are talking about a huge acquisition. Alimentation Couche-Tard is not afraid of acquisitions. They did many acquisitions in the past, but this is their biggest acquisitions. And the Japanese company said, no, we don't want to discuss with you. We want to be acquired. So Alimentation Couche-Tard increased their prices, and the Japanese company said, no, we will be a private company. And at the end of the day, a few weeks ago, Alimentation Couche-Tard said that they don't want to do a hostile takeover. So the acquisition will not fail, but will be cancelled. Okay. Over the past few weeks, we had a couple of uncertainties with these acquisitions, and it seems like the market didn't like this acquisition. When they announced the big acquisition at a big price, the stock dropped. Now that the acquisition is cancelled, there is a high chance that the market will like this news. Market participants don't like uncertainties, don't like risk. So if you remove this acquisition, if you cancel this big uncertainty, this big acquisition of a company that doesn't want to be acquired, that is good for long-term shareholders. That is good for the stock price for 2025. So now we see some recent weakness, low traffic, not a lot of margins at the moment. But Alimentation Couche-Tard has shown for many decades that they will always be profitable, they will always be growing, and they will always be making big acquisitions. They have a history of doing a lot of debt, a lot of leverage to do an acquisition, and then deleveraging, and then new debt and deleveraging. And as they grow, they increase the amount of debt they can take. And we are talking about a company that generates a lot of cash. If you look at the free cash flow over the past decade, it's basically up and to the right. And now they started to do some buybacks. Here and there, you have some buybacks, 4%, 5%. That's fine. And the company is very solid, very strong. Love the management. If you are getting interested in Alimentation Couche-Tard, there is a book on Alain Bouchard, the founder. And yeah, I think this presents a great opportunity at the moment. This is one of the stocks that are great and that will not be impacted by conflicts, by geopolitical tensions, by macroeconomics, because the company is everywhere. So I think it's a great company, great management, and at a pretty good price. The valuation for this business is a PE of 20. So we are talking about a compounder that has grown earnings 18% per year for the past 20 years, available at a PE of 20. That's a decent bet to be. that's a decent bet to me. And if you think earnings will grow in 2025, you can have some good returns for the next year and for 2026. I bet that all the shareholders that bought here in this period of weakness during 2017, they are very happy now. They are very. Is the business giving a dividend? Yeah, a small 1% dividend yield. And since 2017, it's more than a double. So you have a double-digit performance. Great bet, great investment. By the way, if you're looking for a complete framework to analyze stocks and build a strong portfolio, I have a coaching program. More on that at the end of the video. The second stock I want to talk about today is my second largest position. It's Evolution AB. And Evolution AB is in the online Evolution. Oh, that's strange. Is in the online gambling industry. It is not for everybody, but if you are interested in this industry, you will see that this is a growing industry, very fast, very profitable, and the stock has shot up to the stars in 2020-2021 with a valuation PE ratio of 70, and now valuation is coming down from 70 to 60, 50, 40, 30, and now we have a PE ratio of around 15. So you have a pretty cheap valuation compared to the competition, compared to other stocks, especially in the US. And look at the charts. Look at the growth in revenue in blue. Look at the charts in net income. They grow double digits. And now you may argue that the growth has slowed down. But still, we are talking about a company that grows, continues to grow without any debt. They have a lot of cash. They generate a lot of free cash flow. You have a 3% dividend yield, and they start to do some buybacks here and there. And we are talking about a leader by far in the online casino space, online games for casinos. So this is cheap. This is my second largest position at the moment. It's about 15% of my portfolio, and that is one of the best European company I could find. This is based in Sweden, and they are the clear leader. And if you look at the stock chart here, it may sound scary because it's ups and downs, but at the same time you could see the opportunity. Stocks follow earnings. If earnings growth slow down a little bit, the stock will do nothing. If valuation is coming too high, the stock will slow down. But now valuation is low. There may be a multiple expansion over the year, and if the company continues to grow back again, double digits, 20%, 30%, if they continue to grow, start again to grow, the valuation will go up. You will have a multiple expansion, and you will have the stock going up. You will have this double tailwind, more earnings, more valuation. That is very enticing, and I've been buying the stock for 1 year now, and I have averaged down. I bought the stock in December 2023. So I bought here, bought a little bit here. So I'm buying more. It is staying low, and seems like the company is taking advantage of the share price with some share buybacks. And I believe in this company for a few years, for the long term. So that's fine, and I think it's a pretty compelling investment opportunity at the moment, as of December 2024. And the last one is Amazon. I will not describe Amazon. You know what Amazon is. This is a company that is turning the profitability button on. That is a company that is now generating some good free cash flow. AWS is a segment that is fast, growing very, very fast for Amazon, and AWS has some strong margins. So the business segment that is growing the fastest for Amazon is the most profitable one. And now, if you look at, maybe I have this in the business breakdown. No. Let me check. Amazon Web Services. You have AWS as of December 2023. So that's a bit dated, but you will get my point. AWS, approximately 15% of the revenue. The services, approximately 8%. Let's round this up at 20%. These two businesses, these two segments are very profitable, very high margins, and they grow very fast. If they grow 20%, 30%, they will not be 20% of the business. They will have a bigger share of the pie. They will grow to 30% of the business, 40% of the revenue, 50% of the revenue. And this will all move the global margins up for this business. That's my view on Amazon and AWS. I believe this will drastically improve efficiency and profitability for the business. And the runway for Amazon is immense. Yes, they will have to invest a lot in AI. Yes, there will be a lot of costs. Yes, they are everywhere, so they might be disrupted. But Andy Jassy, the CEO, is great. They have a clear vision, and there will be, it's my opinion, there will be a clear leader in this new decade, in this new environment, so until 2030. I believe this is one of the most compelling investment opportunity at the moment, and because of the recent free cash flow improvement, earnings improvement, the valuation has come down because now they boast some large margins, large free cash flow. You have a PE ratio around 30, 40. If you compare this to the past, that's quite cheap. You got one of the best businesses in the world available at a PE of 30. And you may say, now you have a price to free cash flow. You may say, no, don't look at free cash flow because of the heavy capex. Look at the operating cash flow. But okay, let's look at just earnings, around 30. So you get a PE ratio that is reasonable for this kind of quality investing. That's my take on this one. Valuation has very rarely been in this level of 30, 40. So I think the stock is cheap right now. Strangely enough, we are at all-time highs, and I think the stock is still cheap. Not because of the valuation though, but because of the runway, because of the potential over the next few years for AWS and all the marketing stuff with high margins. I think they will grow double digits. I think the world will get more digital. I think the world will have more cloud, and we are talking about the software side of Amazon that is very profitable. And as this share of the pie will grow, the global margins for AWS will grow substantially, and they will generate a lot of earnings, a lot of free cash flow, and they invest a lot in AI, so they will be perfectly positioned to benefit from the next AI trend. So if AI is a new thing for this decade and the 2030s, and that's something relevant and amazing, Amazon is very well positioned. So I think it's a fabulous bet if you want to bet on AI, and also Amazon on it as a normal business, because they have some beautiful business segments and some very good operations with a clear vision, and they always invest for the long term. They always invest in 7-year cycles. They always invest for the long term. So they don't want to think for the next 2 years. They want to invest for the next decade, 2 decades. And if you had invested in any year, if you had invested in Amazon, you would be a very happy shareholder. So yeah, that's it for this video. I hope you find my ideas interesting. If you like this content, I have an investing coaching program. In this program, you will learn a complete investing process. You will learn how to find good stock ideas, how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, in this coaching program, you will have access to my personalized guidance for long-term results. We will do weekly calls where we analyze stocks together, and you will have access to my private number available 24/7 for full support. If you have any questions, I'm here to help. Click the first link in the description below to get more information. You will get a short video that explains how everything works completely for free. No need for your mail address. Just click the first link in the description, and I'll see you on the other side.